Welcome. Thanks for joining us today for our webinar on PPP Round 2. A couple of things before we begin. If you look in the Q&A section, you will see a link to next week's webinar, which is an economic stimulus update. I have also posted a link to sign up for our monthly email newsletter, which includes the latest accounting news, updates, and more. Now let me introduce you to our awesome presenter, the one and only Megan Bronson. Megan is a CPA and an advisory partner here at Squire. She has over a decade of experience working with businesses across several industries, specializing in QuickBooks consulting and outsourced accounting services for manufacturing and distribution clients. And with that, take it away, Megan.
Wonderful. All right. Well, here we are again with Payroll Protection Program, our favorite acronym of the year, PPP. We have been doing a lot of these webinars throughout the last, 10, 12 months, and will continue to do them. So right now I want to kind of dive in, give some updates since the last time we presented, and dive in more to our PPP Round 2, the new act that's come out affecting PPP. So as Whitney mentioned, I'm Megan Bronson, and have been with Squire for over 15 years now. It's exciting, and it's been really great to be part of a company that has felt the social obligation and desire to give back to our community and really dive in and understand these rules and these laws and these opportunities for businesses. It is a proud organization to be a part of, because there aren't a lot of us out here doing that. And so I hope that you recognize that and share with those who you interact with that we're here as a resource if you need us at all. So last time we talked, we were talking about some legislation that was in the works. What we ran into was everything above the line had been done, and everything below the line here had not been happening. It was our hopefuls that these things would hopefully happen. And with the act that passed end of December, we do have these things taken care of. So, the forgiveness, loan forgiveness is not picked up as income. That's always been the case, but the deductions, like the payroll costs and things used to get forgiveness, were going to be disallowed deductions on your tax return, and the IRS has fixed that. So that is now, those costs just get to be deductible anyway. But check your state, because currently Utah has a requirement that the loan forgiveness deductions, the expenses related to loan forgiveness, are going to be added back to income for those costs. And so, I mean, we're talking, the Utah's tax rate is much lower than anything the IRS is charging, but that could be a surprise for a lot of people, is that they're going to have those state income taxes come through. We did get another round of personal stimulus money. We hoped, and it did happen, that the form 3508S, which is our simplified form, was expanded for all PPP loans under 150. So originally at the top we show it being 50. It did get expanded to 150. We did get another round of PPP funding for the businesses, and that's today's focus. One other thing to call out, because I relate to PPP, because I don't think I have it in any of my other slides, is that originally in your PPP forgiveness, the EIDL grant that you would receive would have been up to $10,000, depending on how many employees you had. Those monies were gonna reduce your forgiveness. So you would say, oh, I had $200,000 PPP loan, but I got $10,000 of EIDL grant. The bank was going to, and the SBA were going to forgive you for $190,000, and did that for several people. But with this new act, the EIDL grant is now not to reduce the PPP forgiveness, And so therefore, if so now if you have a $200,000 PPP loan that can be fully forgiven, it will be fully forgiven. You'll keep the $10,000 idle grant and you'll get the full $200,000 forgiveness of your PPP loan. For those who have already achieved forgiveness, which there are a lot who have, and they had this amount held back as in you need to pay this and here it is to pay over the next 2 years or 5 years or whatever. The bank is supposed to fully forgive that portion as well. It's something that they're scrambling to do, so I haven't heard yet whether banks have figured that out. But if you are supposed to be making payments for that portion, or if you aren't sure, then work with your bank, your lender, to receive that full forgiveness, because you do not any longer need to pay back that $3,000 or $10,000 of that grant portion. So some more housekeeping items. So first is, there are still the 4 forgiveness forms to be aware of. Well, technically 5. So the S form is now 150 or less. The easy form is going to be for those who don't need to do a FTE or wage reduction. And then the 3508, the normal form, is for most people will be doing that. So that's just kind of an update to previous slides that we've done. The 3509 for-profit and 3510 not-for-profit, those are the loan necessity questionnaires. If you would like to know more about those, then I look at our previous webinars, because we go deep dive into those things. But I just wanted to make sure we covered that. Also, the deductibility for the tax side of things, I mentioned this, that the loan forgiveness is not taxable for federal purposes. The payroll costs are deductible for federal purposes, but currently Utah is not allowing that deduction. And so you need to make sure you know what's going on in your jurisdictions. Other things to note: the idle grant, that same $3,000 or $10,000 that we talked about, it is not taxable for federal purposes. That's recent that they've clarified that. And then any other grants you receive from economic stimulus, though, are currently taxable. So the default is that economic stimulus grants received are taxable. If it's an economic stimulus loan of some sort that you would have to pay back, then that doesn't even affect your taxability or income at all. So that would be excluded. But for grants where you do not have a repay, they are taxable, except for the exceptions, which the exceptions right now are the idle grant and the PPP loan. And then the other thing to note is payroll tax credits. So if you've been getting payroll tax credits from COVID sick pay or employer retention credits, those are going to be picked up as taxable income for the portion of that credit. And so that is something to note. It's something to note because it's something new that your tax accountants will need to know, because it's not going to be something obvious from your accounting records. So we need to make sure we understand how much you got in payroll credits from reports from your payroll companies, or from your records. Something we talked about last time was accounting for the forgiveness. There are now 2 methods. The AICPA has come out with 2 methods now. First one is what we covered before, where it's a loan. And this is the method I would use if you are, if you feel like you might not achieve full forgiveness. Maybe you're in the over 2 million category and you're worried about whether they are going to award you forgiveness for economic need, the questionnaire. This is something, this is up to management to make that call. We're going to have several people audited according to GAAP, and it's going to be a management call still on that. You'll just have a footnote disclosing your reasons for it. But this is the preferred method, just because it is a loan, and then you achieve forgiveness when you achieve forgiveness, which likely for most people is going to be in 2021. So this is the accounting for that. But the other side of it, which is what I think most small businesses will do, is that you can account for the forgiveness as a grant. And so basically when you receive the proceeds, you set it up as a loan, and then but idle grant would go straight to other income. once you fulfill the grant requirements, meaning you've spent all the PPP money, then you basically say, okay, we've taken care of what the grant ask was, and therefore we can now pick this up as other income. And so everyone had to or likely did get that taken care of during 2020. So a lot of people are going to have a year-end adjustment to say, hey, I'm going to pick up my loan forgiveness as other income in 2020, even though you don't achieve forgiveness till 2021. I even have some who are like, well, it's all in the same year, so they just put their deposit straight to an income account, an other income account, saying we have PPP loans, and but we're going to get forgiven, we know it, and so we're good to go. So this is very different than how the AICPA originally came out, because the likelihood is so great that you will gain full forgiveness. This is something that you can do to just simplify your accounting methods and to not have this sitting, haunting you for the rest of the time. And so anyway, so that's the accounting that I wanted to kind of go over, because that is an update since the last time we presented that this is an option. Let's see. Next, I'm gonna go ahead and dive into PPP. The new PPP rules still have a round 1 provision and a round 2 provision, and so we're going to talk about each of those pretty carefully. But I didn't mention this at first, but I do want to mention it now. If you have any questions, you're welcome to put them into the Q&A, and we'll try to get those answered as we go through the program here. So anyway, so oh, the other thing I want to say is we are having two more webinars in the coming weeks. Next Monday, it's going to be an economic stimulus update, like overall, here's all the things that are happening. And so there'll be a kind of a brief touch on PPP, but most of it will be focused on all the different areas of what's happening on the PPP side, or on the whole Economic CARES Act and the Flexibility Act and the new Continual Support Act. So that is something that to be aware of. Then we are going to also have another webinar that will be a deep dive into the employee retention credit, which if you are not familiar with that is, I do recommend you attend those upcoming webinars, and we will send the links for those registrations out with the materials of today's webinar. But those two webinars are going to be crucial, especially on the employee retention credit, because they've relaxed a lot of the rules. It used to be that you could only do PPP or the employee retention credit, and they now have opened it up so you could have both going on at the same time, and so we need to get you that information. That should be in 2 weeks from today, I believe. So in round 1, so there's still eligible round 1 funding if you did not receive a first draw. So this is for all the people who missed out. They were leery about the program. They didn't understand what was going on, and they missed out, and so they are ready to go. They want to get these funds. So if you did not receive a first draw, but you did exist before February 15th of 2020, so this does not apply to new entities. The limit here on round 1 is the 500 employees, or i.e. a small business status with the SBA. And then you have not permanently closed, and you're not in bankruptcy. Those two scenarios are going to weed out a few other people, but the idea is that this is supposed to be helping your future, right? The PPP money isn't like a income tax credit where whatever happened historically can, you can get refunded for whatever happened historically. The PPP money is supposed to be enabling you to keep people hired going forward. And so it is focused on those who are still open, and so that is the requirement. And then there is a new shuttered venue operator grant that has been announced, and it is extremely lucrative for those who are in the industry of those who are entertainment venues, who hold events, who have movie theaters and productions and things like that. And the details of it are not all there, but essentially it's like you can get up to 45% of your 2019 revenue. So it's a revenue-based thing that is that can give you a ton of a lot more money than the PPP money can. But that is something to be aware of. If you are in that industry, you need to watch out for us to do a webinar on this. We can't do one yet because there's literally like a page of information. If you want to Google it, go Google it and read through what the program is designed to be. But we are hoping that in the next 2 weeks they'll open things up and get a lot more guidance out there. But for now, it's just an announced program that will be extremely helpful to that industry, and we will definitely be here to help get those grants applied for. But you cannot do PPP. So going after round 1 or round 2 at this point in time would make you ineligible for that program. And we're talking about 2.5 months of payroll costs compared to 45% of gross revenue. You definitely want to make sure that you are getting the revenue-based information there. Okay. So next, what you're going to get out of round 1 is similar to what it was originally. You can receive 2.5 months times your average monthly payroll costs. The opening thing here is you can use 2019 or 2020 or 12 months prior to the loan application, like when you're applying for this time. If you do not have a full 12 months of wages, then you need to figure out what is your average monthly payroll cost, and according to what you have paid, and then you'll get 2.5 months of that. And so you do have some flexibility there, more guidance there on how to get that calculated. Payroll costs are still same as before, limited to $100,000 wage per employee. You can add the company portion of health. And here's the new part, you can now add dental, vision, life, and disability insurance. Remember, it's the company portion. So a lot of companies do it where they will provide health and dental, they'll provide dental and vision, but they don't actually cover any of the cost. They just have the employees withhold it. But if you do, as a company, provide that as an employer portion, then you can include that in your payroll costs. That is independent from the 100K limit. So that 100K limit is on the wage of the employee, and then you start adding in these other things. So life and disability insurance, those are usually some good size costs too. You can add the company match for retirement, that's the same. You can add state and local unemployment taxes, that's the same. And then the owner employee limitations are still applying. I have not put in those slides because we covered them in depth back when we were applying for round 1 many months ago. But if you feel like you have any questions there, let me know. But essentially, as a owner employee, you have to include that insurance benefit portion in your 100K, and then also if you have owners who are self-employed owners or owners of partnerships where they are not receiving a W-2, they're not an employee, there is a way to add their portion in as well based on the amount of self-employment income that they were generated from, again, either 2019 or 2020. So whichever one's going to bring you back more, you'll want to use. But your 2020 tax returns aren't due yet, so a lot of people still use 2019. But if it makes sense to do 2020, then like your accountant can probably produce a draft form of the tax return for you to submit with your application, so you don't have to wait around. Okay, so self-employed individuals, if you have no employees and you file a form Schedule C, you get 2.5 times your monthly net profit. So basically, you take your line 31 of your Schedule C, it's capped at 100 grand, divide by 12 months. Again, you can use either 2019 or 2020, whichever is better. If you do have employees, you use your same net income number that we just talked about, but then you add in your employee costs just like the normal employee costs that we talked about as employees. So you basically have these two pieces that you add together. This next one's a new thing. Farmers and ranchers, they report not on a Schedule C, but on a Schedule F. To infuse that industry, they have now allowed them to use their gross income capped at 100 grand instead of their net income. So they originally were the same as Schedule C, where it was the net income portion, but they have now said we're going to make it the gross income so that you can replace your revenues instead of just replacing your take-home pay. And so that's a big change, and that can be really helpful for a lot of people in that industry. And then if you received an EIDL loan prior to April 3rd, so that's kind of before PPP fund started out, I doubt there are very many people in this boat, but technically you could refinance into a PPP loan with this new round. Then you have, because round one has had some changes, there is an opportunity to increase your first loan draw. So these are not just examples of the situations, these are the circumstances that allow you to do it. So number one is you didn't include your partner compensation because you applied before the clarification came last year. So I had a client who last year, they file a self-employed on their Schedule C, which applies in this case too. We filed for their PPP loan application based on employees only because it said don't include your owners or the self-employed individuals because they're supposed to file on their own. So we filed from an employee standpoint, and then we thought we would file separately for his Schedule C standpoint as a self-employed person. And then they came out really closely and said, no, you're supposed to do it all together, but it was too late. And so anyway, they could go back and get round one funding again or increase their round one amount to get that extra amount. And, you know, in this case, they were over 100 grand. And so, so definitely that's, you know, that's 20,833, the 2.5 months worth of that. And that's a big number, and they could go get that money. So that's an opportunity to increase the first loan draw. Another one is originally the seasonal employers could only use a 12-week period between a certain range of dates because they thought COVID was only going to be during that, you know, second quarter of 2020. And so they said only look at the second quarter of 2019 because that's, you know, that's the wages you need to replace right now, right? And now that it's, you know, been obviously way more extreme than everyone's thought, seasonal employers can now look at their best quarter, their best 12 weeks of payroll from 2019 and get a PPP amount based on the best payroll need instead of just for Q2 of 2019. So that's an important distinction there, especially for those who were winter-based businesses who had low payroll going on in those times. So anyway, the ranchers and farmers, so they originally filed with PPP monies only getting them the net, and so now they can go back and file and get the PPP money increased to cover the gross income on their Schedule F forms. And then if you paid back the loan or didn't accept it the full amount because of the economic need callback pressure that they were giving last year. So the last year they said all these people came and got this money, but did you really need it? You shouldn't have taken the money if you could do this and this and this and this. And there were a lot of people who, out of fear, went ahead and returned the money. They're like, I'm going to survive without it. I'm just going to give it back. And so now they're coming back and saying, well, you know, if you gave that money back, you can go ahead and get it again, assuming that you really did need it. You know, if you should have kept it because you really did get hurt economically, then you can go back and get it again. And so that's the fourth scenario. And as I say here, it is not to get that little extra because you had a calculation error. It's not to get the extra vision and dental and life insurance benefit as part of it. Those are immaterial. That's not to SBA. They don't want to handle all the people asking for an extra $2,000 or an extra $15,000. But the other thing that's kind of a kicker for some is if your loan is already forgiven, then it's too late. So in the client example that I shared, their loan actually is forgiven already, and so they cannot get that increased round one. So that's a bummer. But it makes sense because they're like, nope, that's dealt with. We're not going back and opening things back up again.
Megan.
Yep.
It looks like we have a couple of questions that have come in.
Great.
Is now a good time?
Yep, and I will go ahead and read those and address them right now. So how long is the PPP round one going to be open for? So technically this round one and round two are all the same. Like if you haven't gotten round one at all, you're going to get round one now. And then you're not going to have time to get round two unless they totally extend this. Right now the deadline is March 31st to apply for the PPP monies. So the application is open for PPP right now until March 31st. And so you're going to apply for either, you know, first time funds round one or round two. And there's not going to be a way for you to get round one and then turn around and get round two as well. You're going to just get one version. But that could change. Obviously, things change all the time. We've learned a lot about that this year. And so for now, that's the scenarios that you would only get till March 31st to get these applications in, which means you probably don't have the time or the support to get both rounds put in. Although it may not be impossible. It probably depends on your bank on how willing they are to work through all that with you. And then the caveat is that they might extend that. So then we have another question. Will the Utah add back the expenses in the tax year that forgiveness is granted, like 2021, or is it in 2020? So the Utah add back is going to be timed with the expenses deduction. And so your payroll expense and costs are likely all deducted in 2020. And so that's when the add back is going to happen. So it's going to be more timed with the expenses than the forgiveness, if that makes sense. Okay, so I'm going to jump into the next topic, which is going to be this round two. With round two, just to give it a little bit of context, we do have a scenario here where they are focusing on those who've had a harder time than everyone. So pretty much anyone could justify that there was economic need for round one, and for this round two, they are going to make you prove it, that you need the money, that you really were hit hard. So what they've done there is they have a series of qualifications, and it's not too many of them, but it's just things you have to go understand. So one is you have to have had a gross receipts reduction. So that's a 25% reduction in a single calendar quarter of 2020 compared to that same calendar quarter in 2019. And we'll talk about in a minute what gross receipts really means, and but essentially it's just be consistent with what you've always done. Like what'd you call gross receipts a month ago before you heard this opportunity here for PPP round two? you know, a lot of people are going to want to get really creative here and say, well, you know, part of my business really tanked, but the other part was pretty steady, so it's probably okay, but I don't have quite a 25%. But if I just look at this part of my business that tanked, then for sure I need this money. And unfortunately, you do, I mean, you have an argument as far as that you need the money, but that is not going to qualify you for round two. Round two is a company-wide comparison. And it is, you know, it needs to be consistent with, you know, what did you do? What kind of reports were you looking at last year? And what do you consider gross receipts in your business? The economic self-assessment need. Did I or will I spend all the round one funding? Round one funding meaning what you received last year. Have I spent all that money? And most people are going to say, absolutely, it's spent, it's done. There are going to be some who really haven't been able to yet. And that's because they still haven't opened their doors, because they're still shut down in California, where you still can't go eat anywhere. And you know, there's going to be people who still can't, but they can still submit an application for round two. And but the SBA will say, well, once you can say you've spent all of round one, then we'll actually fund you with round two. Because what they don't want to have you dealing with is the trying to track whether your wages for your employees are applying to round one or round two, and definitely you can't have them apply to both. And so they need to have that clean cutoff. So then we go to the next one is, you know, do I still have economic uncertainty ahead of me? And so you may have bounced, like you may have taken a good dive and say, yeah, my Q2 of 2020 was crap, but maybe you know, gotten a new groove and things are good and you're thriving. It's going to be really hard to say, well, yeah, my 2021 revenues have doubled from 2019. Yeah, I needed this money. Like, you want to make sure that you do still need this money. And relative to other people who really are suffering and really do need to have this to help them get afloat and help them get some people hired and working. So the important thing is document your situation when you apply. What are those uncertainties? What restrictions are on you right now? What have you done from a COVID adjustment standpoint of keeping your offices or keeping your stores and restaurants safe? Like, what are you missing out on right now that is giving you this uncertainty? And the more you can document now and basically kind of give this laundry list of justification, that's just documentation on your end. It's not something you're going to hand over to the bank or the SBA yet, until they come knocking, you know, and they finally decide to audit all the applications that they can. They're going to go try to audit as much as they possibly can once the program's all kind of shut down and they've got all the forgiveness applications worked through. Then they're going to go start auditing like crazy for several years. And so document your situation now, so you're not trying to recreate what happened, what was going on right now in a few years. The size of the company, they've dropped this. It was 500 before, and they've dropped it down to 300 employees. And it looks like we have a question on whether that's an FTE equivalent or a head count. And it is a head count. Originally, it was a head count. The 500 employees was a head count. And so that is also the stance here, is that's 300 employee head count for the year, or at any, I guess at the time of, not for the year. The 300 employees right now, like how many employees do you have right now? Is it 300 or less? Then you can be eligible for round two. Okay. So let's dive in a little bit to the gross receipts. So your gross receipts are going to obviously include sales, you know, sales of your products, what services you're providing, what are you charging for those? For nonprofits, it's going to be those contributions, the grants, the gifts. You know, you're already accounting for those as donations received or as funding that you've received. That is all going to be included as gross receipts as you compare. Interest, dividends, and royalties. A lot of people don't put those into a gross receipts number, but they are to be called up into that. If you charge rent or fees or commissions or receive those things, that's all part of your gross receipts. And then you do get to reduce it by your returns and allowances. So that's typically considered a contra revenue account, a negative income account on your P&L, on your income statement. And so that is allowed to stay there as part of your gross receipts. It excludes, so you do not have to do capital gains and losses. So if you sold some equipment or disposed of some things, you do not include those gains or losses in your gross receipts. I mean, unless you are in the business of buying and selling equipment, then it's considered sales. But that's why that character matters. That capital gains and losses you would not include. The sales or other tax, like sales tax or use tax or excise tax or alcohol tax, anything like that that you collect from your customers and turn around and remit, you do not include that in your gross receipts. Most people don't. Like, from an accounting perspective, that should go in as a liability and turn around and get paid to the tax commission of whoever you owe that to, and pay down the liability as you make those payments. It shouldn't be part of your sales numbers. But if you kind of say, well, here's all my deposits, and then I turn around and cut a check to the sales tax team, then or sales tax jurisdictions, then you would want to make sure you pull those out of your sales figures if you're allowing those deposits to be included in your sales figures originally. The forgiveness of the PPP loan, the EIDL advance, those two are not included in gross receipts. From a nonprofit standpoint, or if you are a government entity or anything where you get a lot of those grants on a regular basis, then those would be included. But for those who don't usually operate with grant monies, and you got the EIDL grant or the PPP loan is accounted for as a grant, that is not, I mean, those two kinds of grants are never included in gross receipts. What we don't know is restricted funds for nonprofits. We're waiting on guidance there because, technically a restricted fund comes with a lot of actions you have to do with it. When you receive at the nonprofit level, you receive funds that are targeted for a specific purpose. And so you actually have those restricted and you don't necessarily pick them up as gross receipts until you fulfilled on the required actions. And so we are waiting on guidance on the timing of that, of whether they're going to make you pick that up as when you received the funding, or if they wait and have you deal with it once you do the spending. And so that's something unknown at this point in time. We do have a question. Do we take out cost of goods sold from the gross receipts? So the answer is no. So we are not deducting any costs against this number. This is a sales oriented number. So, typically you have your income and then you subtract out cost of goods sold to get to a gross profit. We're not talking about that number. We're talking about the sales number, the top line, what came into your business that we're looking at comparing. Okay, a few more things on here. So I mentioned you need to use the normally prepared. So if you have monthly or quarterly financial statements that you've been doing for board purposes or management purposes, or even just printing out a QuickBooks that you're used to using, that's what you're supposed to use in this. You're not supposed to sit there and try to find an EBITDA, like earnings before this and this and this, and that's my gross receipts. Like, we're not trying to massage this number at all. It is what you normally use, whatever you normally consider sales and revenues or incoming monies. That's what you use for this analysis. You do not need to be audited, reviewed, or compiled. Although if you do not have that CPA stamp on it, then you will be required to kind of put your own signature on there saying, yep, I attest to this it's kind of makes, you know, basically putting a little more reputation skin in the game as far as assuring that this is accurate and true. You can use cash or accrual or GAAP, whichever you normally use in business. I have several clients who for income or for management purposes, we use accrual basis because that's a better way of managing how their business is doing, but they file taxes on a cash basis. And so in the way I see it is we can look at both of those versions and see which one works out for them better. And inside of QuickBooks, you can click the top, you can toggle the button cash versus accrual in your reports to spit out whichever one you need. And so so I definitely encourage you to try to look at both if you do file cash basis for tax purposes. If you don't, if you file accrual basis for tax purposes, then it's kind of a hard sell to say, well, I'll go cash basis. You probably need to stay accrual basis because that's what you've always been doing. So for those who are simpler or don't have great accounting records, you can use your bank statements, but you have to be able to note that this is sales versus this was an owner contribution versus this was loan proceeds. This I transferred from the other bank account. So you basically have to kind of go through all the deposits on your bank statements and note which ones apply. And then you can look at a full year. So you can use the annual 2020 over 2019. But if you do the whole year comparative, they're going to look at your tax returns, which should match identically. And so just make sure you do make a match, that your 2020 versus 2019 gross receipts numbers match what you report, because that's going to be required to support your forgiveness for it. If you do have a less than a full year of 2019 available to compare, there are specific direction on at what point in time do you have sales, and so here's your here's the window of time you use to compare to the current period. But basically it kind of goes where if you have Q2 of 2019 or Q3 of 2019 or Q4 of 2019, you can compare that. Like if you have any of those quarters, you can compare that with the comparative quarter on 2020. If you do not have 2019 income or gross receipts at all, then you can use Q1 of 2020. So that's the furthest you can go. If you didn't have sales starting until after Q1 of 2020, then you're not going to be able to satisfy this gross receipts. And so therefore you are going to have to not file for round 2 if you didn't have any gross receipts to compare to. So, but you can use Q1 if you don't have the 2019 quarters, but that's not a choice. It's just the last resort you have if you need it. Okay, so then there is going to be documentation required. So you do have to, if your loan's going to be over 150,000, that documentation is required at the time of the loan application, such as, tax returns, bank statements, quarterly financial statements. You're going to say, here, bank, I can prove to you that I've got this reduction in my gross receipts. But for loans under 150K, the SBA is not going to require that at the time of application, but they are going to require it when you file for forgiveness. And so I suspect that all banks are going to be like, well, we want it now, because we're not going to go file a round 2 application on your behalf if you shouldn't have gotten it in the first place. So I don't think that this really helps anybody. I think the banks are going to all require it up front. And I support that, just because you don't want to find out later that you shouldn't have taken the money. You've spent all the money, now you have to pay it back, and you can't pay it back. And so we want to make sure that you deserve the money and qualify for it. So the amounts are fairly similar. You can use the 2019, 2020, or past 12 months. If you don't have a full 12 months, calculate the monthly amount on what you have paid. If you're seasonal, you're going to use some kind of 12-week period between February and February. That makes sense for you. Just a few notes here. The restaurants, hotels, basically anyone with an NAICS code of 7 that starts with 7-2, you're going to get 3.5 months worth of payroll instead of 2.5 months. And this time the funds are capped at 2 million instead of 10 million. So that's important to note that you're not going to be able to get above that 2 million mark. You can add that ability to include the company portion of those other benefits. You cannot refinance an idle loan with the round 2 stuff. And then the Schedule F, the farmers and ranchers, you will use the gross income minus any, if you have employees, you know, you've got the employee portion already calculated for them. For your portion, you would take your gross receipts, but subtract out all that employee portion already, and then be left with a net gross receipts, basically. That way you're not double dipping. Just quickly on the forgiveness side of things, there are more allowable categories. And so historically you could do your payroll costs, you could do your business mortgage interest, your business rent or lease payments, and utility payments. Now you can do operations expenses like the software, the payroll costs, anything associated with tracking this information. So there's a lot there. They have a big list of what's allowable in here, but supplies and things and software that you and services that you have to pay for to get this taken care of can be an allowable expense for forgiveness. Property damage due to COVID-19 public disturbances. So that's going to help with forgiveness for those who had that unfortunate display of non-controlled protests. The essential supplies, so things that you have deem as essential to your business, you can deduct you can have those be part of the forgiveness as well. That's kind of a black hole a little bit, but there are some restrictions on that, but you can get some supplies that you need. And then also the worker protection expenditures. So the capital expenditures you've had to make to allow people to be safely distanced while they're working, all the cleaning supplies, all the masks, anything that you've done expenditure wise related to COVID safety, you're able to include as offsetting your forgiveness. Now, I say that, but what our experience has been is that, again, you're going to have, up to 24 weeks to spend this money, and you're only getting 2.5 months worth, which is like 10 weeks of pay. So 10 weeks of pay you're getting, and you have 24 weeks to spend it. I think we're going to again see the pressure from the banks to include it as little detail as possible, meaning they want you to try to complete your forgiveness through wages only, so they don't have to sit there and review every single credit card receipt and every single vendor invoice and every single office supply that you purchased. They don't want to sit there and have to review all of that stuff. And so technically it's all allowed, but there's still going to be a pressure to try to make it be wages only when it gets time for forgiveness. So I just have another item to cover on takeaways here, and then ready to answer any other questions you guys might have. So go ahead and get those questions in there while I cover this slide. So right now with the lenders, you do not have to use the same lender, but you can. So some of the pros of using the same lender is that you really, most people are going to want to use their 2019 payroll because they probably cut back wages in 2020. And so 2019 data, the lender should already have. And then you really just need to prove that gross receipts calculation, and then they should be able to hit submit. Although the client that I have who has gone through this process still had to gather a bunch of stuff for 2019, not all of it, but basically the banks kind of didn't keep everything that they handed in with their 2019 application or with the original application because they didn't think they needed it. And now here they're like wishing they had it. So now we have to get them some more information from 2019 that we had provided previously. So that's obviously going to be a situational thing. I think this lender is hopefully only one of the few that didn't keep everything, but that is something we run into. Some of the cons of using the same lender is that sometimes the lenders are requiring that forgiveness application to be submitted. You don't have to have forgiveness on a lot of them, but some of them are requiring that you have the application submitted. And what that is that statement I made early on that you have to attest that you have spent all the money or will be spending all the money. And so these lenders are like, well, then if you've spent all the money, then let's just get your forgiveness application in now so we can turn around and do round 2. So that can make it hard because you don't have to get your forgiveness application in now. You can wait and turn that in within 10 months of your end of your covered period, which that could be, October 1 for some people. 10 months later, you're looking at August 1st would be a deadline for applying for forgiveness. So, but it is creating anxiety for when banks and lenders are saying, well, if you haven't submitted your forgiveness application, then you don't get round 2. Let's just go with a different lender. You have to gather your information again, but it's still, you shouldn't have to be tied down to getting your loan forgiveness for round 1 in order to do round 2. There's too many things to get done all at once in a hurry. And there are a lot of them that are not ready to submit round 2. And a lot of them that really didn't have a great experience with round 1. And so maybe you're ready to work with somebody who kind of killed it and made it a good experience for their people for round 1. So it is not required that you use the same lender, but those are some of the pros and cons. Squire, we have ability to connect you with a lender. The lender's Biz to Credit. We have a loan portal that the AICPA has put a ton of resources in to develop for us so that we can, as CPAs, have a place to submit these applications. When it's time to get forgiven for round 2, or even this round of round 1, when that forgiveness happens, the application will almost be fully automated. What they're doing is they're building integrations with banks and with payroll providers to be able to get that data out of those systems that they need to calculate the forgiveness portion, and then it's going to be some button clicks to get it done. And so it can be really powerful and streamlined when it's time to do that. So anyway, let us know if you need a lender for round 2 or even the round 1 version for this open PPP stuff. Just let us know. And then we have 5 more minutes for questions if anyone wants to ask any. So I guess we can say there aren't any questions right this second, so we can say thank you. And there's some contact information. Look at the Q&A published things out there for signups for our future webinars. And we will be sending out this presentation along with links to the future scheduled ones that we've got so far. But anyway, thanks for attending, and let me know if you have any questions at all.